In the world of finance, there's a new kingmaker in town. It's not your typical bank, but this massive, almost invisible force that's deciding which businesses get to grow, which ones get to innovate, and even which ones get acquired. This is the story of private credit. Just look at this number, $2 trillion. That's the estimated size of this, well, some call it a shadow banking system, that has quietly grown to completely reshape how companies get their funding. And what's really wild is that this number has just exploded in a little over a decade. So how on earth did that happen? And maybe more importantly, what does it mean for all of us?
All right, so here's our game plan. We're going to pull back the curtain on private credit. We'll tackle that $2 trillion question. What is this market really? We'll dig into its explosive growth after the 2008 crisis, peek inside the machine to see how it all works, uncover its really surprising connection to traditional banks, and then we'll ask the big one. Is this whole thing an engine for growth, or is it a ticking time bomb?
Okay, so let's start with the big one, the $2 trillion question. What exactly is private credit? Well, to put it simply, it's basically the new main pipeline for business funding, and it's totally rewriting the rules of who gets money and how. So what does this actually mean? Well, at its core, private credit is lending that happens behind closed doors, away from the public markets. So instead of a company going to a huge bank or issuing a public bond that anyone on Wall Street can buy, they go straight to these specialized investment funds. These non-bank lenders give them the loan, and the whole deal stays private. And this is a huge, fundamental shift in how money flows to businesses all over the world. So how did this market get so massive so quickly? Well, the origin story really kicks off with the 2008 global financial crisis. That crisis, it basically created a huge vacuum in the world of lending, and private credit was right there, ready and waiting to fill it. And this timeline just shows the whole transformation perfectly. I mean, think about it. Back in 1994, banks were the main event. They handled over 70% of loans to mid-sized companies. Then, 2008 hit. And in response, a bunch of new regulations made it way harder and more expensive for banks to hold on to riskier loans. So, what did they do? They pulled back. But of course, businesses still needed money. And that's when private debt funds stepped right in. Fast forward to today, and they're financing a staggering 77% of leveraged buyouts. That's when companies are bought using a ton of borrowed money. So we know the why behind the boom, but how does this whole machine actually run? Let's take a look under the hood at some of the key parts and the clever innovations that really make this market tick. Okay, first up, BDCs, or business development companies. The easiest way to think of these guys is as a kind of bridge. They are these special funds that invest in the debt of private companies. But, and here's the cool part, many BDCs are actually publicly traded on the stock market. What that means is that everyday investors like you and me can actually buy shares in a BDC and get exposure to the private credit world, which used to be a playground just for giant institutions.
Now, this is a totally different way of looking at lending. It's not just about how much profit a company is making, it's about the actual stuff a company owns. With asset-based finance, a lender can give a company a loan that's secured by things like its unpaid invoices, its warehouse full of inventory, or even its heavy machinery. The value of those physical things is what unlocks the loan.
And this right here, this is one of the market's killer innovations. See, the old way of getting a big loan was a total headache. It was slow, complicated, kind of like trying to buy all your groceries by going to 5 different stores. But the unitranche loan, that's the one-stop shop. It bundles all the different layers of debt into one single, much simpler loan. It's faster, it's cleaner, and it's a huge reason why so many companies are flocking to private credit.
So you might be thinking that private credit just came in and kicked the banks to the curb. But here's the kicker, and this is where it gets really interesting. The banks didn't disappear, not at all. They're still deeply connected to this new world, but their role has changed. In what's honestly a brilliant move, they've become the lenders to the lenders.
I mean, this chart tells you everything you need to know. The money that big banks are lending directly to these private credit funds has just skyrocketed. We're talking from just $8 billion back in 2013 to $95 billion today. Basically, banks are giving these huge lines of credit to the private lenders who then turn around and use that money to make their own loans. So instead of being rivals, banks have carved out a new and very profitable place in the ecosystem.
So the big question is this super risky for the banks? Well, you might be surprised. Data from the Federal Reserve suggests that so far, it's actually been pretty solid. Yeah, the banks charge a little more interest for these loans, but the risk profile looks pretty good. Look at the delinquency rates. That's the percentage of loans that are overdue. They're incredibly low, well under 1%. And the average credit rating is a respectable triple B, which is what they call investment grade, meaning it's seen as a relatively safe bet.
But you know how it goes. Whenever you have this much money and this much insane growth happening mostly out of the public eye, it's going to start raising some eyebrows. And now that the private credit market is so huge and interconnected, regulators and top financial leaders are definitely starting to ask some very tough questions. And we're not just talking whispers. Listen to this. It's a pretty stark warning from the chair of UBS. They directly compared what's happening in the private credit market to the exact conditions that led to the 2008 meltdown. I mean, when you start hearing echoes of the last financial crisis, you really have to pay attention. So what's got everyone so worried? Well, it really boils down to a few key things. First, there's just a lack of transparency. It's hard to see what's going on. Second, there's the rise of these covenant-light loans. That's basically just a fancy way of saying loans with fewer rules and fewer safety nets for the people lending the money. Third is something called redemption risk. Think of it like a bank run, where all the investors get nervous at once and demand their money back. And finally, the big one. This entire $2 trillion system grew up during a period of relative economic calm. It has never, ever been truly tested by a major painful recession. Which brings us right back to that critical $2 trillion question. Is private credit this powerful, innovative engine that's fueling the new economy? Or is it the ghost of the last crisis, just waiting in the wings? The truth is probably somewhere in the middle. But one thing is for sure. The new kings of lending are here, they're not going anywhere, and how their reign plays out, well, that's going to shape our economy for years to come.